Ottawa and Alberta signed a carbon pricing memorandum this week that, on its face, looks like a tax negotiation. The price is $130 per ton by 2035, and Alberta conceded to an industrial carbon framework it has resisted for years. What that number obscures is the asset it unlocked, a federally committed construction approval date for a West Coast oil pipeline, set for September 1, 2027. That date matters more than the carbon price. Canada has attempted pipeline approvals before and watched them dissolve in regulatory timelines and political reversal. This is the first time a federal government has committed, in writing, to a specific approval deadline rather than a directional aspiration. The mechanism behind that commitment is the political asymmetry it creates. The September 2027 date falls 1 month before Alberta's next provincial election, making reversal politically costlier than delivery. Enbridge moved first among infrastructure holders, publicly warming to the project after the carbon compromise was announced, a shift from its earlier caution on route economics. That repositioning signals where institutional capital is starting to price the probability, not its certainty, but far above the near zero implied in the prior timeline uncertainty. Foreign sovereign buyers, particularly from Asia, had already been flagged by Prime Minister Carney as very attracted to Canada as a reliable LNG export partner, and the pipeline is the physical prerequisite for any credible supply commitment to those partners. The chain runs. Carbon compromise removes the federal precondition that blocked pipeline designation. Designation triggers the national interest fast track, construction approval by September 2027. Enbridge and prospective private investors can underwrite capital with a regulatory anchor rather than a probability estimate. What remains unresolved is the June 30 deadline for Alberta to submit a formal pipeline proposal to Ottawa. Without that submission arriving on time and with an acceptable route, the September 2027 commitment becomes conditional on an input the federal government does not control.
The pipeline deal resolves one macro uncertainty for Canada's energy sector, but the resolution arrives inside a credit environment that is deteriorating faster than in any other G7 economy. That divergence is what makes the pipeline's capital unlock harder to read than the headline suggests. Moody's released a report this week showing Canada's speculative-grade default rate reached approximately 8% in late 2025, up from 2.5% in mid-2022. The global comparable sits at 3% to 4%. The gap is not cyclical noise, it is structural. Nearly half of Canada's speculative-grade issuers are now private equity-owned, up from almost none in the early 2010s, and those sponsors have consistently used debt-funded dividends and leveraged restructurings to extract returns. That strategy compresses the cushion available to absorb any revenue shortfall, and Canada's macro environment is delivering shortfalls across multiple channels simultaneously, inflation and trade disruption. Moody's baseline forecast holds the default rate in a 5 to 7% range through this year. The downside scenario, anchored to a recession trigger, pushes it toward the upper end. That conditional boundary matters for credit positioning. At 7%, speculative-grade spreads begin to reprice across the investment-grade boundary, tightening lending conditions for the broader private sector. At that threshold, the pipeline's private investor tranche, the component the federal government explicitly cannot control, faces a materially higher cost of capital than the deal's economics assumed. The credit stress also concentrates in the same private equity channel that Canadian pension funds are now quietly exiting. Moody's noted that pension plans are shifting away from direct high-risk ownership and toward more selective capital deployment. That rotation means the marginal buyer of Canadian junk risk is thinning at exactly the moment the supply of distressed issuers is growing. Retail and foreign credit investors would need to absorb that gap, and neither has demonstrated appetite at current spreads. The verification benchmark is the Moody's default rate reading for Q2 2026, expected in late July. If the 12-month trailing rate holds below 7%, the pipeline's private capital tranche reprices only modestly. If it crosses 7%, the cost of that capital becomes a structural headwind the September 2027 date cannot legislate away, and the pipeline's economics shift from viable to contingent on public subsidy. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.